I don't know, but when you hear the word hedge fund, what goes through your head? What goes through your body? What are you thinking? As a financial advisor, what comes to mind when you hear the word hedge funds? Is it something that there's some movie that pop up in the back of your mind? Are you thinking about something that, let me run this way? Well, in today's episode, we're getting a little bit more into hedge funds and learning more about them, because at the end of the day, it's about education, understanding, and the more information we have, the better understanding we have, the less scary something becomes. And there might be a lot of opportunity in this. So with that and more right after this. Good morning. Good morning. I hope you are all doing fabulously well on this Friday morning. I see Albert said the last Friday of July. I'm getting goosebumps. Like, can you believe that? A lot of things happening today, specifically in my life. So it is a important day today, and it marks sort of a lot of things that's going to happen going into the future. But look, this show is not about me, but it is quite an exciting Friday at the end of July. And I hope that you are doing extremely well this morning. Thank you for joining us live. If you're watching the recording, thank you very much for doing so. And I hope you're going to find a lot of value in today's episode. Today, we have David back, and David is going to share all the latest current affairs. Now, last week, Lani was here and she only shared bad news. So I hope that David is going to turn things around this time around. And let's hear what he's got to say. And then Norma is going to talk about how to feel better. So now that might be very apt depending on what David is saying in his session, but looking forward to that one. And then we have Razan back with BrandWorks, and she's continuing the discussion around digital assets. And today talking specifically about investment and income generating opportunities. So also excited for that one. A couple of announcements, and then I'm going to introduce you to Alan Yates, who's the head of distribution at Peregrine Capital. And we're going to get into a very awesome discussion around hedge funds. Alrighty, so let me quickly just say good morning, as I always do. Good morning, Quibus, in first for a change. Nice to see you. Good morning, Harry Nell. Good morning. Awesome to see you. And I love that Propulsion family. Thank you very much, Harry. We've got Philip Gary. Good morning, Philip. Thank you for saying hi. Morning, Nantes, OBS. Hope it's going well with you. And looking forward to a lunch very, very soon. Albert, good morning. Thank you very much for saying hi. Jonita, good morning. Hope it's going well over in KZN, as well as our friend Mark, Propulsion people. Hope it's going well in KZN. Now that things are changing today, I will be visiting very shortly. So that list of breakfast places is going to be utilized very soon. Then Kavendra, good morning. Nice to see you. Good morning, Johan. Awesome to see you as well. It's been quite a long time, it feels to me like. Shamaine, good morning. Awesome to see you. Tracy, good morning. Happiness. Thank you for saying hi. And congrats on being part of a very nice sort of Twitter engagement the other day with Nedbank and so forth. So well done on that. Very proud of you. We've got Julie. Good morning, Julie. Nice to see you as always. And Johan de Toit. Yes, all the Toits are all here. Alrighty, so if you're ready, I'm ready. And let's get into today's show and hear what David has to share with us in current affairs.
Good morning, everyone, and welcome to Good News Friday. Yes, for a change, we do have some good news. So today, I'm going to be speaking about the baseline financial literacy study, fuel price predictions, pre-budget consultations, and the best pirates. So good morning. The FSCA has released its financial literacy baseline study. As part of ongoing efforts by the FSCA to better understand, monitor, and promote financial literacy in South Africa, the Human Sciences Research Council has been commissioned to undertake surveys that examine financial knowledge, attitudes, and behavior amongst adult South Africans. The first round of surveys was conducted in 2010, with replications occurring in 2011, 2012, 2013, 2017, and 2020. The surveys consist of nationally representative samples, which means the results reflect the views of South Africans aged 16 or older. So the report, as well as briefing notes, is available on the FSCA website. And for anyone who's interested in financial literacy and education, I would suggest you go and download and read through the reports. Then fuel price predictions. So the fuel price is set to decrease in August. Yes, you heard me right. It's set to decrease. So South Africans will be getting some relief at the petrol pumps with fuel price cuts in August. According to the latest data, it's predicted to decrease by R1.19 to R1.22 of litre, depending on the grade of fuel, and diesel could reduce by more than 80 cents a litre. Now, let's just hope this decrease in fuel feeds into a decrease in some food prices, because in July, the prices were hiked by 10%. Then, National Treasury is soliciting the public's views on South Africa's fiscal policy in its pre-budgeting consultation progress. So South Africa is one of 5 pilot countries that are participating in the Fiscal Openness Accelerator Project, or the FOA. It was launched in 2019 by the International Budget Partnership and the Global Initiative for Fiscal Transparency. And there's some tongue twisters for a Friday morning. So the project's overall objective is to build technical capacity of selected governments, enhance fiscal transparency, and support the implementation of a public participation pilot in the national budget cycle. So an online platform will be provided for respondents to discuss and debate the issues raised in written submissions. So if you do have written submissions, you've got until the 19th of August to submit some budget consultation processes. Then, in honor of Women's Month coming up very shortly, the most successful pirate in history was a woman. In the 19th century, Chinese pirate Xing Shi, a former sex worker and fearsome widow of pirate Zheng I, became a hugely successful pirate in her own right, succeeding her husband and eventually commanding more than 1,800 pirate ships and 80,000 men. I'm sure the secrets she learned in her powerful clients at the brothel also came in handy. So with that, back to you in the studio, Francois.
Alrighty, so yeah, some interesting stuff. That was a quick one, David. I must say it went very, very quick. So thank you very much for that. Really appreciate it. And then next up, we have Norma. And Norma is going to share with us how to feel better. Not that that is so necessary right this second, but who knows what the rest of the year, sort of holds. And then also, I don't know, maybe it's just something that we all need to hear today. So really looking forward to the session with Norma.
Good morning. I'm glad to be back today. So my topic is how to feel better. So a lot of times we hear people say that, they just want to be happy. They just want to be, relaxed, or they want to be at peace or content. And they also tell us the things they don't want. Maybe they don't want to feel overwhelmed. Maybe they don't want to feel so overworked. And a lot of times it sounds like all of those things are outside of themselves, as if they have no control over it. So let's just talk a little bit about that today. The reasons why we feel we don't feel good, and then also, just to recognize those things when it comes up, and then how that impacts our lives. What does that create? And then lastly, I'll just give you 3 ways to maybe feel a little bit better. So the first one is the reason why we don't feel good is purely because we look out into the world and we just want to fix things, we want to control the things, and we want to manipulate our environment. And as we all know, that is very difficult to do, to fix situations, or to fix people, or to make people do the stuff that we want them to do so that we can feel better. So we also, sometimes go and want to find the right job, find the right clients, find the right partner, or that we want to, get into the right body. But all of those things are, again, it's something that we aspire to, and it's almost like we're telling ourselves we can't have that peace or happiness or whatever we're after. We can't have that right now. It's like it's not available to us. So it's important that we recognize those things when it comes up, just purely because we have to then tell ourselves that it's because of what I'm thinking. It's because I'm interpreting the world in this way. So our brain really goes back to, what is familiar, the sentences we keep repeating to ourselves. So if we don't feel good, it's because of something that we're thinking. It's not necessarily about what happens in the world, it's how we are interpreting it. So what this creates in our lives is really that if we don't feel good, we're not necessarily going to be taking any positive actions. So if I feel overwhelmed or anxiety, I won't necessarily go and maybe do new things in my business. I won't necessarily show up as the person I want to be. So it's important to recognize, that not feeling good does have an impact in our lives. So just 3 ways that I can help you and maybe just give you a couple of things that you can do to feel better. And it's quite, very simple things. It's very doable. So the first thing that I recommend is to always separate the facts of any situation from the story that we tell ourselves. So if I, for instance, think that I work much harder than the rest of my employees, that's really the story I'm telling myself. So what is the facts about it? So maybe I can go down and break it down, be more specific. I have 3 employees. This is their job description. This is what they produce on a daily basis. And now, because I have the facts in front of me, I can get maybe more curious. I can maybe start asking questions. Can maybe ask, what else can also be true in this situation? The second thing is that we can constrain and also just simplify our lives. And this is where goals always comes in, because when we set goals, we just give our brain something to focus on and we give our brain direction. So then it's so much easier to see this is where we're going to, and then basically get rid of all the noise that's not going to get us there. And then lastly, just to choose joy over immediate pleasure. And I think a lot of times we don't feel good and we immediately want to feel better. And then we do all those things that gives us pleasure in the moment, but doesn't necessarily contribute to our long-term happiness. So for instance, if I have this task that I need to do in my business, it's going to take a lot of brain power. It's going to maybe be at a stage where I don't really feel like doing it. But because it's on my calendar, because I've allocated time to it, let me just do it because it's going to contribute to me having a successful business. Or maybe that conversations that I have on a daily basis with my partner. Do I want to be right all the time, or do I want to have joy over time? Maybe, more thinking about having a healthy relationship over time than being right every single day. So those are the things that I recommend doing. There's a whole lot of other stuff as well. We only have time for these things today. So this is what I have for you regarding how to feel better. And I hope you can implement this in your life. Thank you for being here. I'll be back next week.
Righty. It's been a while since we've had Razan on the show to talk about brand work. So finally she's back. She's had a bit of a hectic schedule. And so happy to have her back this morning. And continuing, the last time she was here, she was talking about digital assets. And specifically, if you remember, talking about the Google business profile or something like that. Razan, shoot me if I've got that wrong. But anyway, that was extremely insightful and very, very valuable. And then also now, today, she's continuing this conversation and talking about investing and income generating opportunities from digital assets. So with that, let's hear what she's got to say.
Good morning to everybody and welcome to this segment of BrandWorks brought to you by ProPulsion. Yes, Francois, last week or the previous segment, we did talk about Google business profiles and we're continuing that discussion today with digital real estate and why the time to invest time and money is now. So just to recap from the previous segment, the term digital real estate refers to property or any digital asset that exists on the internet that you can own and that can also be bought or sold. Basic examples are websites, domain names, digital products, and also social media handles or accounts. And these extend all the way to NFTs, property in the metaverse, etc. But for today, we're just going to focus on those basic ones. Now, typically we see these as spaces that fall under the marketing budget to showcase our brand. And it's often mistakenly viewed as income drainers and not income generators. In theory, if you have an asset that you're putting time and money into, is that not a classic example of a typical investment? Digital real estate can be ideal investment opportunities, and the base of all is you are in full control. Your digital asset will perform as well as the time and effort that you take to prune and grow it. It boils down to I'm willing to give X of my money and time because I will get Y in return. Digital assets from the get-go should be approached from an investment perspective. And these days, there are a multitude of low effort, low cost, high effort, high cost, medium effort, no cost opportunities available. So the opportunities really are endless. The big thing is just to start. And to get started, just start at the beginning and don't overcomplicate it. So the top one thing that you can do today to claim your piece of digital real estate is go and register your personal domain name. Whether you will use it or not, it is simply good practice. And trust me, you're going to feel so much better for it. You can get a .co.za or a .com, and they range from about 90 to 350 Rand per year. And if you're ahead with the curve, which you might still be, considering how unique our South African names are, you might just get your exact name as your domain name. Now, it goes without saying that the same counts for registering your business name. The one thing to look out for there is that often when we start a new company, we fail to check domain availability. And we also fail to check against which other domains your domain name needs to compete within the same space online. So checking domain availability and registering your domain is stop number one in claiming your investment stake in digital real estate. Now that you have your domain, what can you do with it? Well, you can either add a website to it, and if you don't have a website, it is not a problem. Domain redirects are common practice. Now, a domain redirect is when you have your domain that you've bought and you have it point to another digital asset that you have online that's already there and active. Now, for instance, I have Razan.com. Now, if you type in Razan.com, it'll redirect to my profile me. You can have your domain redirect basically to anything. You can have it redirect to your LinkedIn profile, to your Instagram profile, or even just a PDF that you've put online. Once you have your domain, and you feel so much better because you have it, you have ownership now, and you can have it direct. You can have people direct people that visit it or click on it to places that are income-generating opportunities or places that will become income-generating opportunities as you prune and grow it. The key is to look at your digital assets as digital investments. And the punchline is that you can make that investment as early as just now with relatively low effort. Remember, your digital assets, aka your investments, will perform as well as the time that you take to prune and grow it. So that's all from me today. In the next segment, we're going to be talking about making your digital assets, tangible assets, as part of your client experience. Have a wonderful day.
Alrighty, thank you very much, Razan. So with that, it's time for some announcements quickly. And obviously the only thing I'm talking about at this stage is the upcoming summit. And so if you haven't got your ticket yet, please go and do that. This week we announced another keynote speaker, and next week we'll announce the last two. Or maybe today, maybe I'll throw a bonus one today. We'll do that. But this week we announced that Igno van Niekerk will be one of the keynote speakers. Igno is also doing one of the segments here on the show called Change Your Angle, and really excited to have Igno as part of the summit. He is a phenomenal storyteller, and he is funny, and he's entertaining. But man, is he like the impact that man has, and just the energy that he brings to anything is just absolutely amazing. So he's going to talk about, and just listen to this title. We were talking about this, and then obviously the theme of the summit is raising the bar, and he goes like, I'll talk about a financial advisor walks into a bar. So there's a play there. Really excited to sort of hear what that's going to be about. Remember, the unique format we've got for the summit is that the keynotes are only 10 minutes in length. So we have people, like all the keynote speakers only have 10 minutes, including the Douglas Krugers and the Ryan Stramroods and those people that talk on international stages and are almost used to doing things in either 20, 30 or 40 minutes. I really challenge them to raise the bar and to do that. And so happy that all of them have said yes. So come and join us for that specifically. We have 6 phenomenal panels with some of the most amazing people from around the world that are panelists on this panel. We've got great facilitators. I met with all of them yesterday, so really excited about that. But yeah, come and join us for the summit. And the summit, if I can put the details here on the screen quickly, it's on the 23rd of August. And it's Tuesday, the 23rd, and it's going to be from 9 a.m. in the morning until 2 p.m. completely live. We're doing everything live. I don't even have backup recording. So we are, touch wood and hoping that Eskom holds and that the internet holds, which it's never given up on me. So I'm very confident about that. But we are going out live. We don't want to do pre-recorded stuff. And we want the engagement to be real and the engagement to be there. So really looking forward to that. So if you want to go check it out, just propulsion.co.za. You can find all the info there, or just go to propulsionsummit.com. The links are down below on the YouTube channel, and you will find all the information you need, as well as the agenda to see what's going to happen. And it will be fantastic to have you join us for that specifically. So, yeah, without any further ado, I'm going to take a sip of my tea and then just let you buy your ticket quickly. Remember, Propulsion Pro members don't have to buy a ticket because it's included in your membership. And with that, I'm going to introduce you to our featured guest right after this. There we go. Good morning, Alan. Welcome to Propulsion Live.
Hi, Francois. Thanks so much for having me. It's great.
Awesome. Loving the fireplace there in the background. Can we just that's real, right? I can see the light falling on you. It's absolutely real.
I definitely need it to be real, 100%. This I live in a very old house, and it's one of those ones where it doesn't matter what you do. I could burn down the furniture. It's still not going to get warm.
Yeah. So, Alan, just thanks a lot for being here and for spending time with us today. This is quite an interesting conversation for me. I've never spoken to anybody about hedge funds and those kind of things. And it feels to me, like I said in the opening, that, when you hear the word hedge fund, you just see extraordinary risk. And you see that, this is something I need to stay away from, and my clients need to stay away from a normal financial advisor perspective, right? Financial planner perspective, because it feels like hedge funds are these very specific, very special things for very special people almost, in my view. And that's sort of why I thought, let's talk about hedge funds, because this is quite an interesting thing. And the more we can learn about it, the more we can maybe see the value. But before we get into that, Alan, just maybe a brief introduction of who you are and what you do at Peregrine Capital.
Sure, 100%. So I'm head of distribution at Peregrine. And really, I suppose what that entails in a normal business, a normal asset management business, that really just entails going out and marketing your products. But as you mentioned, in a hedge fund business, probably 80% of my job is actually education, because it's an asset class that's very misunderstood. It's an asset class that's very unknown in the wider sort of financial advisor community. So that truthfully is a big part of what me and my team do. Is really just to try and obviously get the Peregrine Capital brand out there, because we're not a big shop. We're not an Alan Gray or a Coro who everyone knows. So it is getting the brand out there, but also educating people about hedge funds, because they are, I think, incredibly valuable tools, but they are tools that have some significant misconceptions around them in the market.
Yeah, I'm really looking forward to this conversation. So thanks for your time. Let's get into hedge funds, almost like sort of hedge funds 101, right? What are they? In essence, what is a hedge fund and what is it meant to do?
Cool. So I mean, broadly speaking, at a very basic level, a hedge fund is very similar to most of the unit trusts that guys use and invest in every day. So it's that they're regulated in exactly the same fashion. So we also regulate it by the FSCA. They are multi-asset portfolios, so you're going to have a combination of various assets inside the underlying portfolio, and I think very importantly, a huge variety of risk profiles as well. I mean, when people say to me, "Yeah, but hedge funds are risky," I think that the honest truth is I can always reply by saying some hedge funds are absolutely, but in the same way that some equity funds that are taking very concentrated bets and exposure to very small cap stocks would be similar. So I think the category itself is incredibly broad. It is a very small part of the industry of the asset management industry, but it is still nonetheless a very broad category in terms of risk profiles and sort of what the funds are looking to achieve. So in that instance, very similar to what guys are used to. The parts I think that are different about a hedge fund is really twofold. Number one is we have what we call a bi-directional investment strategy. And really all that means is that we have some additional tools in the toolbox when we're looking to invest money for our clients. It means that we can take a view and hopefully generate alpha and generate performance regardless of what the equity markets are doing or the bond markets are doing here and abroad. So it's the appeal of it is that you can create that return and that hopefully consistent return for investors, even in down markets, sideways trending markets. I mean, a year like this year is a great example. It's been a horrible year for equity funds, for equity markets in general, for bond assets, etc. But in the hedge space, we've found it to be a pretty good year because we do have the ability to generate those returns with that additional toolbox, as we refer to it. And then I think the second part that is somewhat different is that a hedge fund by tradition, now I mean, again, exceptions to the rule, but I think specifically in South Africa, a hedge fund is there to reduce the risk in a portfolio. It's there to reduce the correlation to the other assets that your clients might hold in their portfolios, and it's there to kind of smooth the ride. I think is the best way of putting it, and that for us, certainly at Peregrine Capital, and I think broadly speaking for hedge fund managers in South Africa, is the big piece of value add that we can bring to the table is that we can bring a product that can be added to a client's portfolio that's just going to make the ride smoother and more comfortable for them over time. And then obviously that, and hopefully what that means is that the possibility of people disinvesting when markets are volatile or troubling decreases. And that, I mean, I think from an advisor perspective, so I mean, just to give you a bit of background on myself, I spent 13 years investing before I joined Peregrine, and I was in the private client sort of wealth management space. So I remember and can think of countless times where your clients invariably panic towards the bottom, and sell out at probably absolutely the wrong time, because that's when they get sort of to the peak of pessimism, and having a hedge fund in the portfolio just reduces the potential for that disinvestment at the wrong time, I think, and that's really what's very important.
Yeah, and there's now a couple of questions that are sort of pops into my mind, and one of them, I want to talk about correlation just in a second, but
sure,
like if hedge funds are like sort of, I mean, playing both ways, right? You said it's a bi-directional investment.
Yes.
What would you say is the main reason that most investment managers do not follow this approach and still just look at one directional? So we bet on equities, we bet on bonds and a combination thereof, etc. Why is it that there's a small section, and I'm assuming it's a small section of the market that do offer hedge funds, whereas the rest do the traditional, let's call it traditional sort of investing? Yes. Is there a big reason for that specifically?
So I think, I mean, there's a couple of reasons, but let me start by saying that actually from an institutional allocator perspective, so where I'm talking sort of, the big life companies, the big multi-management businesses, the pension and provident fund managers, hedge has been part of their solutions for decades. I mean, we've had the likes of an Alex Forbes as an example. They've been investing with us for 20 years. I mean, this is definitely not something that's new to them or different, and they've seen the value throughout the last 2 decades. And the same can be said for a lot of institutional money managers. But I think what the other point to make is that In South Africa, it's a very small part of the market. Absolutely, yes. I mean, the hedge fund industry in SA, to give you an idea, is roughly probably about 80 billion rand. I mean, it's a drop in the ocean compared to the rest of the savings industry. But if you look offshore and if you look globally, I mean, if you take somewhere like America as an example, they've got roughly 10,000 listed mutual funds and 8,000 hedge funds. You know, so I mean, it's a market that is very, very similar in size to the sort of long only space, as we call it. The second point, I suppose, is around the skill set required to manage a hedge fund. You know, obviously, by having these additional tools in the toolbox, it means that the fund manager needs to know how to use those and how to use those prudently and consistently, and how to sort of manage the assets in a prudent and somewhat sensitive manner. And I think in that case, you find, and there are a few fund managers in South Africa, hedge fund managers who've been around. I mean, like ourselves, we've been around for 24 years, excuse me. There are a couple of other really well-known guys. I mean, 361 as an example, that have been doing this for a long time, and they're really good at it. You know, these guys are highly skilled fund managers, and they know how to utilize the full toolbox, and that's really what you're after. You know, I mean, I think if a lot of guys, if other asset management businesses were comfortable and capable in making sure that they could do that for clients, I'm sure you'd probably see more of them managing funds like this. Because, I mean, if you think about it, if you have a talented asset manager, a portfolio manager who can really generate good returns, good alpha, you want to give him as much flexibility and as many tools as possible to do that for investors, to generate the best possible returns. And I think that is exactly what hedge funds do. I mean, it's we as a business, Peregrine as a business, have turned down many long-only equity mandates from some very large investors over time, purely because we just don't think it's the best vehicle. You know, it's kind of you're investing with one hand strapped behind your back, so to speak, because you're reliant on a market that's going up. And absolutely, that works a lot of the time. You know, markets generally tend to trend upwards, over a long period of time, 100%. But in years like this year, as an example, this is where hedge really comes to the fore for people and should be adding significant value.
Yeah, and fantastic. So the next question then, we talked about correlation, and to change that correlation, what is correlation, number one? Maybe if we can just explain what we talk about when we talk about correlation, and then, what is the benefit of that, and what are you looking for? Like, I tend to, if you compare, let's say, for example, 3 balanced funds to each other, just normal balanced unit trusts, and you look at the top 10 holdings, are you really getting diversification? If you look at their correlation, if they all move in the same fashion at the same rate, kind of thing, according to the correlation, then are you really getting diversification? So, I mean, when you talk about correlation, like, what are we really talking about?
So the honest truth is that what we're talking, when I talk about correlation, I'm talking about 2 things. Number one is obviously what happens to the returns of our funds when relative to what the equity market's doing. So relative to the All Zeal, the Capswix, whatever you measure. And as you say, I mean, I have exactly this slide on that point. I have the 5 largest balanced funds in South Africa and their correlation metrics versus the overall market, and you'll see that those numbers are very similar and very high. So your average big sort of high equity balanced funds probably got a correlation of between 80 and 90% to the Capswix. What that means is very simply that whatever the return of the Capswix is doing, so or the ALSI, so let's say if the markets are trending up, those funds will be trending up as well, because they are very correlated. Whereas if the markets are falling in a heap, those funds are falling in a heap as well, because the market is very correlated. Whereas with our funds, so I mean, to give you an example, our pure hedge fund only has less than 20% correlation to the market. So it means that when those balanced funds and the rest of your portfolio, particularly if you think of the traditional 60-40 split, right? The balanced mandate that's been proliferated in South Africa for a very, very long time. That is if you add us to that kind of approach, all we're going to do is we're going to bring a different income stream, different return generating profile to an overall portfolio. So it means very simply that when those 3 balanced funds that you've got all move exactly the same and in unison, we're hopefully going to move in a very different direction when you need us to. And that's what we kind of talk about when I say correlation. So, I mean, to give you an example, if I were to say to if you would say to me, okay, cool, I've got a fund where I'm 40% in bonds, 60% in equities. What would adding Hedge to that portfolio do for me? I'm hoping it's going to do three things. And I mean, I'm obviously just talking about our funds now, but this is probably applicable to the wider category. Number one, it needs to improve your performance. Because I mean, at the end of the day, that's what investors, that's why people are putting their money at risk, is to grow their assets so they can live a better life. I mean, that's the end result. So we need to make sure that we can grow those assets over time for them at a rate that's significantly higher than inflation, so that they are getting wealthier and are able to do more things with their lives. Number two is that we hopefully bring in significantly better risk management to the portfolio. And the reason for that is twofold. One is, I would like to say, is that our fund managers are really skilled people. They're very good at their jobs. They've been doing this a long time. They've got, they're very talented. But two is that because you've got that additional toolkit, and if you use that toolkit properly, it means that you can protect on the downside, and you can hopefully allow that investor to have a much smoother experience. So I mean, as an example, in 2020 with COVID, when COVID hit, markets obviously took a big knock. So the first quarter of that year, I think the Aussie was down something like 26% for the first 3 months of 2020. Our pure hedge fund was up like a couple of percent, and our high growth fund was down less than 1%. And that's really allows that investor to have a significantly better chance of then recapturing the upside on the way up, and not having to suffer that significant loss. And as I mentioned earlier, the problem with a lot of people, and it's just general human psychology, is that as things get more and more dire, there's a tendency to panic and sell out at the wrong time. So by having the hedge funds in there with that low correlation, it hopefully means that the person with the hedge fund, a portfolio that has the hedge funds in it, is so much more likely to be able to emotionally weather that storm, sit through it, and come out the other side fully invested. And that's really, I suppose, what we as asset managers and financial advisors in general want for their clients. They want the best possible outcomes, and I think Hedge allows that to happen.
And there's a question or a comment here that I sort of want to bring up and just sort of share that. And it's Charmaine that says hedge funds are allowed to pool funds, which is the main difference between them and the normal asset managers. Can we sort of just maybe quickly talk about that?
So I mean, when she says pool funds, I suppose, look, let me put it to you like this. A hedge fund is a unit trust, right? So that's exactly the same structure as a pool mandate, absolutely. The main difference is our ability to use two things. One is shorting, which is obviously when we can bet against the business or hedge out index exposure, whatever the case may be. And then two is the use of derivatives. So that's essentially, and derivatives, I mean, this is where I think of it is an insurance policy. It's like buying insurance, right? So for an example, in 2020, when we were talking about now, the reason our funds were positive over that time period was because we purchased that insurance against the market falling. So when the market fell, that option was in the money, and that the bank that we purchased that option from had to pay us, or pay the funds the commensurate amount to make sure that they've made us whole again. So those are the main two additional tools that we have in the toolkit. So I mean, I think alternatively, it's exactly the same as a traditional unit trust in terms of the way you get in, the way you get out, the way it's treated from a tax perspective, etc.
Awesome. Let's just talk a little bit about the advice framework. So if we look at that, and I think we've touched on many of these aspects probably as we've been talking this morning, but just to be more explicit and say, okay, so as a financial advisor, financial planner, investment planner, retirement planner, like whatever role you're playing at a specific point in time, where does hedge funds fit exactly into this? Like, when do you consider, and quite interesting to me, I did not know, for example, that you also have, call it, for lack of a better term, like risk profiled funds. So it may be hedge funds and it might be high risk, but there's different levels of risk for different use cases. So where does this all fit into the advice framework, if you will?
Okay, 100%. Great question. So I mean, I think the answer is it is certainly around from a portfolio construction perspective, it is, I suppose, if you think of like a core satellite approach, I think hedge funds play a great role in the satellite side. I'm certainly not going out to the market to say to them, dump all your balanced funds and only invest in a hedge fund. I don't think that's prudent, and I don't think anyone, wants to do that anyways. What it does mean is that, and again, I'll just use a couple of our own examples. So our pure hedge fund, which is a very conservatively managed, low risk investment, has a maximum net exposure to equities of 20%. So I mean, it's not taking a lot of exposure to equity markets at all. It's really just looking to generate a consistent above CPI sort of return for investors. So that kind of product is a fantastic product to sit in a living annuity, or for anyone who's really looking to, who's generated wealth over time. They're now looking to protect that wealth, obviously continue to grow it, making sure that it's beating inflation, that you're getting real returns, but that you really are just trying to first and foremost have stability and have protection in that fund. So that's the pure hedge fund, and that's what's referred to as a market neutral fund. So that's, and as the name suggests, that's a fund that's not taking sort of big exposures to equity markets. So where that would fit in, I think living annuities is an obvious one. That's certainly where we've seen a huge amount of application from the financial advisor community. And then the second side of it is, so our second product is what is called our high growth fund, and that, from an asset allocation perspective, looks very similar to a balanced fund. So it's going to be running, I don't know, anywhere between sort of 60 and 80% net equity. So you do have some beta exposure in that fund, absolutely. But again, likewise, so that one's there to maximize risk-adjusted returns. And I think, so I mean, this is a stat I love to put out, but so when that fund, at the inception of that fund in 2000, if you put R1 million in the fund on day one, at the moment you would be sitting with about 126 million rand. So I mean, it's done 126 times money for investors. That is it's a life-changing outcome. I mean, I think that's, if I can do that for people, and if we can offer a product that does that for investors, I mean, surely there's a hell of a lot of value in that, because it can truly change lives.
Yeah, absolutely. And I guess it's about having the right strategy and then employing the right tools in that strategy that is appropriate to the situation, appropriate to the investor, to the time frame, 100%. To a whole host of things that needs to. So none of the other things are out the window when you do planning. It's the same concepts. It's just whether do you introduce this stuff or not. And obviously my view is on this that you've got to educate yourself and you've got to understand this. And I want to get into some of the misconceptions around hedge funds. Sure. We've already touched again on a few of this, and this is what's so awesome about just having a conversation, is that we tend to talk about different things at different times, and then we can reiterate them. But I mean, one of the things, and I will bring this comment up, and I think it links to what I said in the intro, to some of the things we've spoken about and what we're about to talk about now, because I want to talk a little bit about the first thing is risk, right? So my question is, you said earlier that these funds, like hedge funds, those kind of funds, are introduced actually to lower risk, but the perception is sort of the other way around. Now, if you look at, so Kobus is saying, like, there's a stigmatization or stigmatization or whatever it is. Like, my English has also been used up on, like, by Wednesday, to it for serious risk. So some real nasty global stories. And I don't know, why does the Wolf of Wall Street come to mind? I mean, like, I think that's the kind of risk that you think about when you think about hedge funds, right? It's just like it happens.
100%. So I mean, I can tell you. I mean, so the honest truth is, I think hedge funds, whoever did the PR job for hedge funds failed dismally. I mean, I'm trying to fix it, but my God, we haven't done ourselves any favors. So I mean, when I normally talk to an advisor about a hedge fund, 99% of guys have really never heard of or considered hedge funds for their clients. So I think we are a very new proposition to the market. So education is totally key. And I mean, you referred to Wolf of Wall Street, right? I mean, he wasn't even a hedge fund manager, but we got his vibe anyways. Exactly. There was that program Billions. I mean, that's the one that everyone goes, oh, you're a hedge fund manager like in Billions. I'm like, no, absolutely nothing like in Billions. There's no midget tossing. No one's addicted to heavy drugs. it is actually a bunch of really nerdy guys sitting in an office all day, thinking about stocks. But I think so. I mean, particularly to Kobus's point there, is that I think you've seen some very highly publicized failures in the hedge industry, particularly in America. And I think the hedge industry in America is a very different industry to in South Africa, whereas we are very conservatively managed. Well, we're conservative fund managers by nature, but the second side of it is hedge funds in South Africa are regulated. So the FSCA is, we've got regulation exactly like a unit trust from the FSCA, whereas in America they are unregulated products. And that obviously introduces risk. It means that the fund manager, globally fund managers can add a lot of additional leverage to their portfolios, whatever the case might be, and that can introduce additional risks. Absolutely. I think when you talk about hedge funds in South Africa, you've got to differentiate them from the sort of American model and that the Wolf of Wall Street billions kind of imagery, because that absolutely isn't what we are about. I think for us, what we've worked out, I suppose this is kind of the benefit of having a track record of 24 years, is that you have tried many things and you've iterated along the way. And what we've worked out, truthfully, is that if you can just protect the losses, you protect the funds on the downside. So if you don't, first off, if you don't have any major landmines going off in your portfolio, so if you're not in the Steinoffs when they blow up, etc., that's half the battle won already. Secondly, is that if you're not suffering the downside, then you don't need to chase the returns on the when the markets turn around again. So it means that you don't have to introduce additional amounts of risk. That you can be pretty conservatively positioned and not capture all the upside of the market on the way up, because you did the hard yards with the risk protection on the way down. So for us, I think the answer is, the perception is certainly there that hedge funds are riskier. There's no doubt about it. But it is, hedge funds are it's such a broad category that you actually, very different strokes for very different folks. And there are some products in South Africa where, guys are running a very concentrated portfolio that's kind of 6 and out. You'll see some funds that do 30, 40, 50% return the 1 year, and then they're down 40 the next. But I think that's not a feature of hedge funds. It's a feature of asset management. I can point out unit trusts that have done exactly the same thing over time as well. So it's from a risk perspective for us, it is absolutely about reducing overall risk in a portfolio. I mean, if you chat to my portfolio managers and you say to them, what's your riskiest investment, they'll tell you that if they were putting money in a 100% equity fund, that would make them super nervous. Like that's not what they're about. That's not what they want to be, and that's not what they want to manage, because for them that is a really high risk product.
And talking about risk, I think another part of risk, so there's the inherent risk of the market, but then also, getting access to my money. So liquidity is always a big one as well. And yes. I think hedge funds are also perceived to be very illiquid. It's not easy to get one when you're in. It's not easy to get your money out, and that does pose a risk, because, like, if the markets move, because it's illiquid, you can't move with, etc. Is that the case?
So I mean, the honest truth is, if you and I had this conversation 3 years ago, I could certainly say to you that there's a valid that is a valid argument. So traditionally hedge funds were normally monthly dealing, so it meant that you could only get in and out of the product on a particular single day of the month, and that obviously then means that it is cumbersome for, first of all, go to any list platform in South Africa and tell them you'd like to list a hedge fund that deals only on a monthly basis. I mean, I did that in the beginning, and everyone just, got a lot of people laughing at me and hanging up. So we learned very quickly that in order to participate in the retail market, you had to solve for that liquidity issue, and you had to solve for the minimum investment issue. So a traditional, what's called a QI hedge fund, which is a qualified investor hedge fund, that's kind of really what all of us started out managing back in the day. A traditional QI fund has a minimum investment size of R1 million, and is therefore, and also it was traditionally monthly dealing. So that just excludes, any access via lists, but it also just excludes the vast majority of the retail market. You know, I mean, not a lot of people have R1 million to put into a hedge fund when it's not going to be it's not going to be 80% of your portfolio. Maybe it's going to be 20% of your portfolio. But that then means you need proper money to be able to participate. So what we've done at Peregrine specifically is we've launched retail versions of the products. So they are daily dealing. The minimum investment size is like 25,000 Rand. You can do a 1,000 Rand debit order. And by doing that, we have managed to get the products onto, I want to say every list in South Africa. I'm sure there's one or two that I might not be on, but certainly all the major list platforms we are available on. And I think that's kind of the key that's unlocked Hedge as a real viable choice for financial advisors, is because they can now access it as, you know, add them to the models, add them to the wraps, have them on the list platforms, etc.
And would you say, like, if you think about, again, like we've spoken this, like people are avoiding this. If I say people, I'm referring to financial advisors, because ultimately, I mean, clients that are very well informed may seek out these kind of investments or these kind of portfolios, if you will. But in most instances, I would say that it's either an advisor that would make them aware that this is something, this is an option, this is what we do. So that's also where, you know, often why it doesn't happen. And I mean, this fear around hedge funds, because I think the biggest thing that I've seen recently, again, you know, is that a lot of advisors are also investing their clients extremely in a very cautious, very conservative manner. Because I think one of the things that we struggle with is having those conversations when things are not going well in 2008 and 2020. And like, one, you don't want to have those conversations. And two, when you do have to have them, it's not a nice experience usually. So we avoid anything that sort of goes that way, or could go that way rather. So, I mean, do you think that if you think about that fear, you know, is there, like, how do we solve that? How do we, not just only from a hedge fund perspective, or using hedge fund as part of your portfolio? And again, you're not going to put everything into a hedge fund. It's going to be part of the solution. But like, how do we help advisors move from, you know, not investing what's best for me almost, and I say that with respect, because it makes it easier for me, there's less for me to explain, versus you know, doing what we actually should be doing for that particular client.
Yes, absolutely, 100%. So, look, I mean, I think the answer is that it is boiling down to education. So it shows exactly like you're running right now with me, where hopefully we can get out to advisors and explain to them how a hedge fund works, what the sort of, you know, the mechanics are behind it, and that they can get comfortable enough to understand that this is a properly valuable option for their clients, and it is something that they need to consider. So, I mean, I suppose I could say to you that up until the global financial crisis, first of all, the South African equity market was the best performing equity market in the world over the previous 100 years. So you didn't really need an additional solution to generate the returns you wanted, because the market was doing it for you. And if it ain't broke, you know, why fix it? And I totally understand that argument and agree with it. However, I mean, we've seen in the past decade in South Africa, equity market returns and even bond market returns have not allowed investors to grow their wealth at the rate that they need to. You know, I mean, I think for someone that's you know, a super wealthy investor, this is the irony, is that high net worth clients generally have always been part of our client base. You know, we've got lots of, you know, wealthy guys who are very astute and know that this is a great way to compound their money. But actually, the people that need these solutions, that need the performance that comes out of these hedge funds and the you know, the additional value that they bring to a portfolio, are the people that are not in that, you know, ultra high net worth category, are the people that really do need, you know, need a retail solution and need their financial advisors to give them that guidance. But I think it's just it does boil down just to education. Look, and I think the other thing worth mentioning here is that I think brand, from an asset management perspective, is incredibly powerful. You know, I mean, if you look at the likes of an Alan Gray or a Coronation, they've done an exceptional marketing job. You know, regardless of their returns, or, you know, whether you think they are good money managers or not. If you're a financial advisor and you go to you know, Joe Bloggs down the street and you say, Joe, I want to put you into an Alan Gray fund, he knows what Alan Gray is. He's, you know, like, he's seen the adverts. It's a household name. Whereas if you go to him and say, listen, I want to put you in a fund that's managed by Peregrine Capital, he's got no idea who we are. Yeah, I mean, 99% of advisors had no idea who we were until 3 years ago. So it's a conundrum. I think that for us, it's a conundrum of being a boutique asset manager as opposed to an asset manager who has, a giant budget to go and spend hugely on advertising. That's not our model. So really, what we're trying to do from our perspective at Peregrine is to educate as many financial advisors as possible that they see the value. And you see that, I mean, that light bulb moment happens when you put these returns up in front of guys and you put the correlation up in front of guys and you show them a blend. You literally say to them, here's your 60-40 portfolio over the last 10 years. This is what it's given you. If you'd added a 20% slug to hedge, I've literally upped your return by whatever it is, 50%, reduced your max drawdown and reduced your volatility. And that's obviously something that adds value to a portfolio. Sorry, excuse me. And I think, for me, I suppose if I can say one thing to everyone that's listening from a financial advisory perspective is that if you do the work, if you do understand these products and you do start using them, they are going to add incredible value to your clients' lives. And obviously they're going to make, hopefully, your conversations a lot easier. I mean, if you talk about, when things go wrong, right? So let's talk about 2020. There were a lot of really unhappy people in South African equity markets because it struggled significantly. Whereas the people in my funds were incredibly happy with their lives because, they got kind of 15% from pure hedge and 17% or whatever it was from high growth in a year where the market's giving you a donut. And that, I think, is the value here, but it's an educational thing that we've got to drive on, and that's our prerogative, and I mean that's our responsibility as an industry. If we want to come into the retail space, which certainly we as Peregrine do, then it's incumbent on us to do the education.
Yep, I fully agree. And in 1 minute, I want to end off on a question. How do we compare these sort of, how do you know whether this fund is doing what it's supposed to be doing? Like the reason you put it into the strategy, like how do we compare that now to, like, I mean, it's easy to compare balance funds and all these other funds because you've got all the stuff. How do you know whether this fund actually did what it was supposed to do?
Sure.
I think I'd rather say meant to do.
Meant to do, yeah, absolutely. So I think the answer is you need to look for a fund manager, a hedge fund manager that has a significant track record, because I think, and we've seen it over the years, you guys, a part of investing is luck, absolutely, and over maybe a 1 year, even a 3 year period, that luck element has a large impact on overall returns. Over a 10, 15, 20 year time horizon, that luck element draws back down to zero because invariably swings and roundabouts happen. So if you can go find a fund manager, so I mean, as an example, our high growth fund, it's been around, as I said, since 2000, so it's been around 22 years. That since inception returns there on average is 24% per annum after fees. I mean, that shows you that this fund has been through all sorts of market cycles. I mean, when we launched, we went through emerging market debt crisis. We've gone through the GFC. We've gone through the pigs. We've gone through Nanny-gate. We've gone through the Ukraine-Russia invasion. We've gone through COVID. We've gone through all of these things, and it's the investment process, as opposed to the fund itself. It's the investment process that has stood up over that time and has shown that it can cope with that. And I think that's the main battle here. Is you obviously want to select a manager who has a proven track record, because that's the best way to know that their investment process works.
Yeah. And on that note, Alan, thank you so much. This was a very insightful conversation. Really enjoyed it. Thank you very much for being here and for sharing all of this with us. I'm pretty sure that everyone got loads of value out of this. So I just got the website on the screen. There are links down below as well. You can also connect with Alan on LinkedIn and also with Peregrine on LinkedIn, but also their website, peregrine.co.za. And on that note, Alan, thank you very much. I hope you have a fantastic weekend. Keep on doing the good work, and I'll see you somewhere shortly.
Thank you so much. Thanks for the time.
It's a big pleasure. Alrighty, so what a morning. Really enjoyed that. So thank you very much, Alan, for being with us. Really enjoyed it. And yeah, excited for next week. Next week, I've got another guest, and there's going to be another riveting conversation. So please join us next week, same time, same place. And yeah, have a fantastic weekend. Stay safe, be blessed, and prosper. And remember to raise the bar. Love you. Bye-bye.